Imagine waking up one day to find out your entire company was built on a lie. Not a small lie, an $11 billion lie. That's exactly what happened to 80,000 WorldCom employees in 2002 when their CEO's house of cards came crashing down. This is the story of one of the biggest corporate frauds in American history. In the late 1990s, WorldCom was unstoppable. They were the second largest long-distance phone company in America, handling half of all internet traffic in the U.S. Their stock was soaring. Wall Street loved them. CEO Bernard Ebbers was being called a visionary. But behind the scenes, the numbers were all fake. And when the truth came out, it didn't just destroy the company, it changed corporate America forever. By the end of this video, you'll understand exactly how they pulled it off, why they got caught, and what it means for business today. Let's dive in. To understand how WorldCom collapsed, you first need to understand how they got so big. WorldCom started small in 1983 as LDDS, a long-distance discount provider in Mississippi. But under CEO Bernard Ebbers, the company went on an acquisition spree throughout the 1990s. They bought over 60 companies, MCI, UUNet, Brooks Fiber. Each acquisition made WorldCom bigger, more powerful, more impressive to Wall Street. By 1999, WorldCom was worth over $180 billion. Ebbers was a rock star CEO. Investors couldn't get enough. But here's the problem. All that growth was expensive. And when the dot-com bubble started to burst in 2000, WorldCom faced a harsh reality. The telecom industry was overcrowded, prices were dropping, competition was fierce, and WorldCom's actual profits, they were shrinking fast. But Wall Street expected growth, investors expected profits, and Bernard Ebbers had built his entire empire on delivering both. So he made a choice, a catastrophic choice. If the real numbers weren't good enough, he'd just make up better ones. Here's how the fraud worked, and honestly, it's almost embarrassingly simple. Every business has two types of costs. Operating expenses are your day-to-day costs, rent, salaries, utilities. You have to report these immediately and reduce your profits right away. Capital expenditures are long-term investments, buildings, equipment, infrastructure. You can spread these costs out over many years. WorldCom's biggest operating expense was something called line costs. These were the fees they paid to other telecom companies to use their networks. Totally normal, totally routine, and totally supposed to be counted as operating expenses. But here's what WorldCom did instead. They just reclassified them. They took billions of dollars in line costs and recorded them as capital expenditures instead. On paper, their operating expenses looked way lower, their profits looked way higher. Wall Street was happy, the stock price stayed up, and nobody knew the numbers were completely fabricated. This wasn't a complicated scheme. There were no offshore accounts, no shell companies, just accountants typing the wrong numbers into spreadsheets, month after month, quarter after quarter. From 1999 to 2002, they hid over $11 billion in expenses this way. CFO Scott Sullivan orchestrated it, Controller David Myers executed it, and CEO Bernard Ebbers, he pushed for the results that made it necessary. But someone was paying attention. Her name was Cynthia Cooper, and she was WorldCom's internal audit vice president. In early 2002, she started noticing things that didn't add up. Capital expenditures were way too high. The numbers didn't match what she knew about the company's actual operations. So she started digging. Late at night, when other executives had gone home, Cooper and her small team would search through WorldCom's accounting records. What they found was shocking. Billions of dollars in line costs, improperly capitalized, no documentation, no justification, just entries that made the profits look better than they actually were. In June 2002, Cooper took her findings to the audit committee of WorldCom's board of directors. The jig was up. On June 25, 2002, WorldCom publicly announced it had improperly accounted for $3.8 billion in expenses. The stock, which had once traded at $64 per share, plummeted to less than $1. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy. At the time, it was the largest bankruptcy in U.S. history.
80,000 jobs were on the line. Investors had lost billions. Retirement funds were wiped out. In the executives, CFO Scott Sullivan was fired. He eventually pled guilty and cooperated with prosecutors. Controller David Myers also pled guilty. And Bernard Ebbers? He was convicted of fraud, conspiracy, and filing false documents in 2005. He was sentenced to 25 years in federal prison. He served 13 years before being released in 2019 due to declining health. He died in 2020. But the damage was already done. The WorldCom scandal didn't just destroy one company, it shook the entire corporate world. Coming right after the Enron scandal, WorldCom proved that America's biggest companies could be cooking their books on a massive scale, and nobody would know until it was too late. Congress responded with the Sarbanes-Oxley Act of 2002, one of the most significant reforms in corporate governance history. SOX, as it's called, created strict new rules for financial reporting, auditing, and corporate accountability. CEOs and CFOs now have to personally certify their financial statements. Audit committees got more power. Penalties for fraud got way harsher. WorldCom eventually emerged from bankruptcy as MCI Inc. in 2004. Verizon bought them in 2006 for $8.5 billion, a fraction of what WorldCom was once worth. But here's what really matters. The WorldCom scandal is a reminder that no company is too big to fail when the numbers are fake, that pressure to meet Wall Street expectations can lead smart people to make catastrophically stupid decisions, and that sometimes it takes just one person asking the right questions to bring down an $11 billion fraud. Cynthia Cooper became one of Time magazine's Persons of the Year in 2002, along with 2 other corporate whistleblowers. She did the right thing, even when it meant going against her bosses, her company, and risking her career. So, that's the WorldCom story. An $11 billion accounting fraud, a CEO who thought he was untouchable, and a collapse that changed corporate America forever. If you found this interesting, hit that like button and subscribe for more deep dives into corporate scandals, financial disasters, and the wild stories behind business history. Drop a comment below. What corporate scandal should I cover next? Enron, Theranos, FTX? Let me know. Thanks for watching, and I'll see you in the next one.